Will gold and silver continue to outperform the stock market? Are gold and silver better investments than stocks? This is a question many investors ask, especially in times of global economic uncertainty, rising inflation, and financial instability. In this video, we will analyze historical data, the advantages and risks of gold, silver, and stocks, and provide specific investment strategies to maximize returns. 1. What has history proven? Before deciding whether to invest in gold, silver, or stocks, we need to examine historical data to understand when precious metals outperform stocks and when the stock market wins. The 1970s, high inflation, gold's explosive growth. In 1971, the US ended the gold standard, causing gold prices to rise dramatically. Over the next decade, gold surged from $35 to over $850 per ounce, over 2,000% growth, while the S&P 500 remained nearly flat. Silver also skyrocketed from $1.50 to nearly $50 per ounce, hitting a record high in 1980. 2008 financial crisis, gold shines again. When the stock market crashed, the S&P 500 lost more than 50% of its value. Gold surged from $700 to over $1,900 by 2011, plus 170%. Silver also peaked near $50 per ounce, quadrupling in value from pre-crisis levels. The 2010s, the stock market boom. After the crisis, the stock market rebounded strongly due to low interest rates and economic stimulus policies. The S&P 500 soared over 300% from 2010 to 2020, while gold and silver declined. Gold-silver tend to outperform during crises, high inflation, or when confidence in currency weakens. Stocks win when the economy grows and companies thrive. 2. Gold-silver versus stocks, advantages and risks. Gold-silver, safe haven or financial trap? Are gold and silver truly safe haven assets, or are they just speculative investments? Some view them as protection against inflation and crises, while others argue they do not generate real value and can be manipulated. So, should you invest in gold and silver? Let's break down the facts. Why are gold-silver considered safe assets? 1. Protection against inflation. When paper currency loses value, gold and silver tend to rise. Example, in the 1970s, US inflation reached 13% per year, and gold surged from $35 to over $850 per ounce, over 2,000% growth. During 2020 to 2022, when inflation spiked after COVID-19, gold reached nearly $2,100 per ounce. 2. Immune to central bank policies. Paper money can be printed endlessly, but gold-silver are finite resources and cannot be created out of thin air. When central banks like the Federal Reserve inject money into the economy, fiat currency can lose value, while gold and silver retain their worth. 3. Safe haven in times of crisis. When the economy is unstable, gold and silver tend to increase in value as investors seek safe assets. Examples: 2008 financial crisis, gold jumped 170%, from $700 to over $1,900. COVID-19 pandemic, 2020 gold surged from $1,500 to $2,000, setting a historical record. 1. Gold-silver always retain value over time, especially during crises high inflation. Gold and silver have historically been safe haven assets, maintaining their value even during economic downturns, market crashes, and high inflation. Investors turn to these metals when the stock market becomes volatile, or when central banks print excessive money, leading to inflation. However, is gold-silver truly the best investment? Or is it a financial trap? Let's break it down. Backhand index pointing down. 2. The downsides. Could this be a financial trap? Gold-silver do not generate cash flow. Unlike stocks or real estate, gold-silver do not generate passive income, dividends, interest, or cash flow. If you hold 1 kilogram of gold for 10 years, it remains 1 kilogram of gold. Meanwhile, stocks can multiply in value significantly over time. Unpredictable price fluctuations. Market manipulation. Gold-silver prices are influenced not only by supply and demand but also by large institutions and banks manipulating the market. Silver is particularly vulnerable to price manipulation. For example, in 2020, JP Morgan was fined over $920 million for manipulating silver prices. Long-term returns are lower than stocks. Over long periods, gold-silver underperform compared to stocks. Example: from 1980 to 2020, gold increased by only 300%, while the S&P 500 grew by over 3,000%. If you invested $1,000 in gold in 1980, you would now have around $4,000. If you invested the same amount in the S&P 500, you'd have over $40,000. Conclusion: while gold-silver help protect wealth, if you want to grow your wealth rapidly, stocks remain the superior choice. 3. So, how should you invest? Strategy 1. Don't go all in on gold-silver. Avoid putting all your money into gold-silver, as they do not create long-term value. Instead, allocate 5 to 20% of your portfolio to gold-silver for risk hedging. Strategy 2. Combine stocks. Precious metals. During high inflation or economic crises, increase gold-silver holdings to 10 to 20% of your portfolio. During strong economic growth, reduce gold-silver allocation to just 5% for safety. Strategy 3. Smart investing. ETF stocks instead of physical gold. Instead of buying physical gold, consider investing in gold-silver ETFs or mining companies. Gold-silver ETFs: SPDR Gold Trust, GLD, iShares Silver Trust, SLV. Gold mining stocks: Barrick Gold, Gold, Newmont Corporation, NEM. 4. Gold-silver, treasure or trap. Gold-silver are excellent safe haven assets, protecting against economic downturns and inflation. They do not generate cash flow and have lower long-term returns than stocks. What do you think? Are gold-silver truly a safe asset or just a financial trap? Comment below. And don't forget to subscribe for more investing insights. Stocks, the long-term path to wealth. Why are stocks considered one of the best ways to build long-term wealth? History has shown that patient investors with a clear strategy have the potential to build sustainable wealth through the stock market. However, with great opportunities come significant risks, and understanding both is key to making smart investment decisions. Today, let's dive deep into the advantages and risks of stock investing so you can decide whether this path is right for you. 1. Advantages of stock investing. 1. High long-term returns. The stock market has consistently delivered higher returns than most other asset classes. The S&P 500, which represents the 500 largest U.S. companies, has grown at an average rate of 8 to 10% per year for over 100 years. Comparison with other investment options. Bank savings average 5 to 7% per year, but often fails to keep up with inflation. Real estate grows 6 to 8% per year, but requires large capital, low liquidity, and high maintenance costs. Gold averages 5 to 6% per year, but mostly acts as a safe store of value rather than a wealth-building asset. Example: if you invested $10,000 in the S&P 500 in 1980, by 2024, it could be worth over $1 million. If you bought Apple AAPL shares for $1,000 in 2000, your investment could now be worth 500 times more. The stock market offers massive returns if you invest for the long term and choose the right stocks or funds. 2. The power of compound interest, the wealth machine. Compound interest is when the profits you earn continue to be reinvested to generate even greater returns over time. Example: if you invest $1,000 in the S&P 500 with an average annual return of 10%, your investment would grow as follows. 10 years later, $2, $600. 20 years later, $6, $700. 30 years later, $17, $500. 50 years later, $117,000. The earlier you start investing, the more time your assets have to grow. High liquidity, buy sell with ease. Unlike real estate, which can take months to sell a property, stocks can be bought or sold instantly with just a few clicks. Benefits of high liquidity. You can sell when you need cash without taking a huge loss, if you time it right. Easily adjust your portfolio when market conditions change. If you're looking for an investment channel that offers flexibility without being tied to physical assets, stocks are a great choice. Flexible investment, suitable for any budget. You don't need millions to start investing. You can start with just a few dollars instead of requiring huge capital like real estate. You can buy Apple AAPL or Tesla TSLA stocks with just a few $100s. Invest in ETF funds, SP 500, NASDAQ 100, with as little as $50 to $100 per month. Anyone can start investing in stocks without needing a large amount of capital. Diversification, reduce risk, maximize returns. You can invest in multiple industries to minimize risk and take advantage of different market trends. Technology, Apple, Microsoft, Tesla. Consumer goods, Coca-Cola, McDonald's. Finance, JP Morgan Chase, Goldman Sachs. Energy, oil, ExxonMobil, Chevron. Diversification helps protect your portfolio from major losses and increases your chances of profit. Risks of stock investing. Price volatility, stocks don't always go up. Stock prices can soar rapidly but also crash dramatically. Historical examples. 2008 financial crisis, SP 500 dropped 50%. COVID-19 crash, 2020 the market fell over 30% in just weeks. Tip: only invest money you don't need immediately, and stay committed to long-term investing. Company risk, not every business succeeds. Some once dominant companies have collapsed over time. Nokia, Yahoo, Blockbuster, once industry leaders, now nearly extinct. Solution: always research before investing, and choose companies with strong financials and long-term potential. FOMO, fear of missing out, buying high, selling low. Many investors buy at peak prices due to FOMO, then panic sell when prices drop. Tip: avoid following the crowd, always have a clear strategy. Inflation risk, picking the right stocks matters. If you only invest in low-growth stocks, your returns might not outpace inflation. Solution: invest in companies with high profitability and sustainable growth. Is stock investing the path to wealth? The answer is yes, if you invest wisely. Stocks offer higher long-term returns than most other investment options. But the risks are high if you don't have a solid strategy. Are you ready to invest? Share your thoughts in the comments below. And don't forget to like, subscribe for more valuable investment insights. How to invest effectively, combining long-term, short-term strategies. Should you invest long-term or short-term? This is a question that many investors struggle with. In reality, there is no single, best way. Combining both strategies intelligently helps maximize returns and minimize risks. What we'll cover today. Long-term investing, how to build wealth over time. Short-term investing, how to take advantage of market fluctuations for quick profits. How to combine both to achieve optimal returns in the US stock market. Let's dive in. How to invest effectively, combining long-term, short-term strategies. Should you invest for the long term or trade short term? This is a common dilemma for many investors. In reality, there's no single best approach. A smart combination of both can help you maximize profits while managing risks effectively. In today's discussion, we'll cover long-term investing, a proven method for building sustainable wealth. Short-term investing, a way to capitalize on market fluctuations for quick profits. A combined strategy to optimize returns in the US stock market. 1. Long-term investing, the path to sustainable wealth. Definition: long-term investing means buying stocks or funds and holding them for 5, 10, 20 years, or more. The goal is to leverage compound interest and business growth to accumulate wealth over time. Why is long-term investing effective? Historical evidence. the S&P 500 has delivered an average annual return of 8 to 10% over the past 100 plus years. Compounding returns. Reinvesting profits allows your money to grow exponentially. Lower risk. Markets may fluctuate in the short term, but they generally trend upward in the long run. Real-life examples. If you invested $10,000 in the S&P 500 in 1980, by 2024, it would have grown to over $1 million. Buying Amazon AMZN stock in 2000 at just $5 per share, it has now skyrocketed to over $3,000 per share. Effective long-term investment strategies. Buy stocks of leading companies: Apple AAPL, Microsoft, MSFT, Google, GOGL, Amazon AMZN. Invest in index funds, ETFs such as SP 500 ETF, SPY, NASDAQ 100 ETF, QQQ, for diversification. Use dollar cost averaging, DCA. Invest a fixed amount each month, regardless of market fluctuations. Pro tip: if you don't want to spend too much time monitoring the market, long-term investing is the best way to build wealth sustainably. 2. Short-term investing, capitalizing on quick money-making opportunities. Definition: short-term investing involves buying and selling stocks over a short period, from a few days to a few months, to profit from price fluctuations. Why consider short-term investing? Quick profits, no need to wait years to see returns. Leverage price movements, stocks like Tesla, TSLA, Nvidia, NVDA, and Meta, experience large swings. Higher liquidity, your capital isn't tied up for long periods, allowing flexibility. Real-life examples. Tesla, TSLA, in 2023, the stock price surged from $108 to $293, doubling accounts for those who bought at the low points. Netflix, NFLX, in March 2020, it was around $300, but by October 2021, it soared to $700. Effective short-term investment strategies. Swing trading, buy stocks when they dip and sell when they rise, holding for weeks to months. Day trading, buy and sell within the same day, profiting from small price movements, for experienced investors. Follow market news, earnings reports, Federal Reserve interest rate decisions, and inflation, CPI, data heavily impact the market. Warning: short-term investing can be highly profitable but also comes with higher risk, requiring a clear strategy and strict discipline. 3. The best of both worlds, combining long-term short-term investing. How can you effectively combine long-term and short-term investing? Optimal capital allocation formula. 50% in long-term investments, build wealth with ETFs, SP 500, NASDAQ 100, or blue-chip stocks, Apple, Microsoft. 30% in short-term trades, take advantage of tech stocks or volatile stocks, Tesla, Nvidia. 20% in cash reserves or gold, ready to buy when the market dips. Example portfolio allocation for a $100,000 investment. $50,000 in SP 500 ETF for steady long-term growth. $30,000 in Tesla, AMD, or Netflix for short-term trades. $20,000 in cash reserves to capitalize on market downturns. Benefits of this strategy: generates short-term income from trading, harnesses compound interest for long-term wealth building, minimizes risk during market volatility. The winning investment formula. Long-term investing builds stable wealth and benefits from compounding interest. Short-term investing provides quick profits and capitalizes on market waves. Combining both optimizes returns and mitigates risks. Which strategy do you prefer? Long-term, short-term, or a mix of both? Drop a comment below and don't forget to subscribe for more smart investing insights.